Hello traders, what's going on? Welcome to Nimbus Capital ad hoc market update. Currently, we are very early in the morning, 8:25 a.m. I don't usually wake up this early because okay lah, sometimes I wake up about 8:45 shortly before the market open. And we are on the 2nd of December. The reason for this ad hoc update is because sometime in the morning, we see that the S&P 500, the Dow Jones, the US index in general, it dropped another 1.5% to 2%. And this is attributed to, the media attribute this to the Omicron variant that was discovered on the US. So due to that, the markets kind of like spook and then price start to drop further. So the purpose of this update is to look at if these drops are significant and if crucial levels are being broken for counters that we are holding. But as with all Nimbus Capital trades, our stop loss is designed with the chart structure in mind. Meaning if the stop loss is not hit, then of course it goes to shows that the crucial level are still not broken yet. But of course, we want to have a good idea of what's going on. So on my chart here, right, you can see the S&P index have fallen quite a bit from the top. So from the most recent high, if I were to take the wick, not just the closing, if I were to take the wick, right, the highest was 4745, like that, 4745. Okay lah, let's round it to 4745, a little bit OCD. Everything must be multiple of 5. Okay, and when we draw it back down all the way to the recent low, it is currently dropped about 5% from the top. Compare this to the previous drop that we see here, it is about 6% drop. And if we look at this entire uptrend that we have seen from the March 2020 low, right? The highest drop that we seen during this whole uptrend was somewhere around here. And the drop was about 10%, about 10% like that. So if we compare to this 10% drop, right, it does seems like that 10% drop was the worst case scenario. And in this situation right here, we are only halfway to 10%. So you might want to sort of account for another additional 5% drop, which might seem to coincide with this support level itself, because if we kind of look at the previous support level, it comes to about 9% like that. So even if it like if we account for a little bit of overshooting, right, then we are somewhere close to 10% drop. But we have to keep in mind also that when the market dropped right here, the reason why it has such a big decline here is because this was the first time that the price overtook pre-COVID high for S&P 500. So each time when the market overtook the previous high, it tend to have a drastic, violent reaction in a way that a lot of traders, they are quite happy that, okay, the market is back to previous high now. So a lot of traders who were holding a lot of rate, a lot of losses, they suddenly break even, and then they want to just quickly take the opportunity to exit at break even, or perhaps those who manage to bottom pick at the low, they want to take their profit there because it has reached the resistance, which is why whenever you see the previous high being taken, you always see a violent drop. You always see a violent drop, and even here, you always see this violent drop. Okay, but when we look at this stage here, there isn't any previous high. There isn't any previous high here. This is the highest high. So that's why the uptrend is kind of sustained, because I believe whatever that is going on right now, it does not have sufficient catalyst to make the market drop until this bad, like back in 2020. Because back in 2020, it was the first COVID case. COVID-19 was finally brought upon the world, hence the entire world panic. we are at this time still dealing with COVID, but we have a lot of preparation in place already. We have a lot of vaccine, whether you believe in vaccination or not, but definitely we have the broad market seems to believe in vaccination. It doesn't matter what you believe. Okay. So as long as the broad market believe in vaccination, I think the market is able to sort of tide through this. Why do I say the broad market believe in vaccination? Because Pfizer is going up. Moderna also have rebounded from the previous low. So it is quite obvious. It is quite obvious that market is pro vaccine. Okay. So let's not discuss the morality issue of vaccination and forcing vaccine onto people or what, but the market does believe in vaccine. So compare S&P to Dow Jones. Compare S&P to Dow Jones. Dow Jones is actually very close to the previous support level. And in fact, back in September, October period, right, it managed to hit the previous support before S&P even came to hit that previous support level. And if you compare to the S&P 500, Dow Jones didn't really went up a lot from the October low compared to S&P. S&P kind of like chong all the way up, but Dow Jones is kind of like a bit only, and then after that it start to fall back down. It start to fall back down to currently, which is at the support level. This is because you do have to keep in mind that while both are definitely US market, there are some key differences between Dow Jones and S&P 500. You have to understand that Dow Jones comprise of a lot of companies that give out good dividends, such as McDonald's, Coca-Cola, all these dividend giving companies, whereas S&P 500 is typically more focused on growth. So when market recover, S&P 500 does climb up a lot higher. Also, not to forget that the FANG counters are mainly in S&P. Although Apple is in both S&P and Dow Jones, right? S&P does have a few key players that are driving the faster, the more aggressive rally, and these key players are, of course, Nvidia, Tesla, Facebook, and Alphabet. Google. Surprisingly, Google is not on the Dow Jones, which kind of a little bit funny, but I guess Google only came into popularity very recently only in terms of market years, right? I would say Google is kind of recent compared to say Microsoft, which has been around for like God knows how many years already. Okay, so while Dow Jones is already back at support, S&P is still quite a bit further from the support is, but it is also at what we call a very crucial level in an uptrend, and that is the resistance, the previous resistance level. But at this stage, it is hard to assume that this will be supported because we don't see any sign, we don't see any evidence of it being supported yet. And in fact, the momentum of the price going down is still quite a lot. And even if this area were to get supported in the future, the momentum can still bring in like another few red candle before it start to come back up. So you will you will see that it is not always a very nice one single line like that. It is not always one single line like this, where what you will expect is more of like something like this. Something like this, there's a bit of overlapping. Oh, okay. my drawing not very good, but you will see this kind of overlapping now. Okay, so it is still early to say S&P has supported, but who knows, we still have 2 more market days for this week. We will continue to see. But taking a look at the position that we have right now, most of them have of course dropped by quite a bit, but I want you to focus on all the back counters. Back counters, by back counters, what I mean is those that are downtrend for quite some time already. For example, we have Alibaba. Alibaba still continue to dive further from the earning report. like quite jala already. It is somewhere about another 16% down already, which is quite bad. And similarly for PayPal, it is another about 12% drop. So that's why we do not trade downtrend counters, and we try to stay away from downtrend counters because the drop is pretty bad. When S&P is going up, they are dropping. When S&P drop, they also drop. So these are counters that when the market is good, they are bad. When the market is bad, they are worse. So these are counters that you will want to avoid. But if we look at some of our so-called the better counters, for example, Apple, our initial entry when the video came out was somewhere here. Yes, it does drop during the market, but you can see that the drop is not so bad. And even then, it is still a net positive from what we have. So, and the reason why it is net positive is mainly because it is an uptrend. It is a very strong uptrend. And here, right, what you will see is you will probably not see your account going into very red. But if you have counter like Apple, you might be like from a floating profit of like $5,000, for example. Maybe your profit dropped back to like $2,000. So you lost like $3,000, but that $3,000 is a net profit that is gone lah. So what you do is you simply have to wait for the market to recover, and your green will become more green. Compared to, let's say, if you are in Alibaba or PayPal, God forbid that you are holding on to PayPal. PayPal already hit the stop loss. So if you are still holding on to PayPal, that there's something wrong with your discipline already. Okay. So imagine you have a PayPal trade, and then you are holding on to PayPal and you refuse to cut, right? What you will see is you will see your loss becoming bigger and bigger and bigger and bigger. And that is something that is emotionally more damaging compared to seeing a profit becoming smaller, because you are still, when a profit becomes smaller, you are still retaining your original capital. Your whatever amount that you put is still there. It's just that the profit becomes smaller, and you have the holding power. You have the holding power because you know that this counter is still strong. It can probably recover when market recovers. So you can still hold. So it's easy to hold a profit to become more profit rather than to hold a loss to become like profit again. Okay, so in that same level, right? If you look at counters like Home Depot, yes, it does drop from the high, but the kind of drop is not very huge. That kind of drop is not very huge. It is about 3%. And if we look at Micron Technology, yes, it is a little bit stagnant. The market is quite bad, but you see how this kind of stock they manage to maintain. And even for Nvidia, right, they still manage to maintain at the top. It is still a net positive if you sort of look at it from all the position that we have. Of course, for Netflix, it does drop by quite a bit. But when we look at our latest trade, the positive entry, right, it is dropping just by a tiny bit from our initial entry. So it might go into a small rate, but it is not something that is overly worrying or something that you need to start exiting all your entire portfolio and like go and hide in one corner, that kind of stuff lah. So yes, sometimes we do have counters such as digital holding, which we have eventually hit the stop loss yesterday. We do have counters such as this, but what you need to realize is that I always mention we need to approach trading from a statistical perspective, and it is that if we trade all the uptrend counters, most likely 70 to 80% of all the uptrend counters will be like Apple, like Micron, like Nvidia, and there will be that 20-30% that is going to end up like DigitalOcean. Yes, very aggressive rally, but when it does drop very aggressive also. So in this kind of situation, right, what you do is very simple. You simply just take the loss, because this movement is evidence that probably DigitalOcean is not a very strong counter that is unable to face a broad market retracement. Whenever the market retrace a bit, this one like from the building jump down already, and we simply just cut the loss. So if your risk is 2% of your entire portfolio, so for example, if I have a 10K account, I will probably lose $200 on this trade. And this $200, you can use it as you can think of it as an insurance. So it's like you pay $200 to tell yourself that this is not a counter that you want to hold for long term. So you simply just let it go. So that's how you can picture your stop loss cutting. And the worst thing you can do is in this kind of moment is that you cannot continue to hold on, you cannot continue to double down to sort of convince yourself that, oh, this one can still continue to go up. Can it continue to go up? Yes, it can. But once again, we always look at it from statistical perspective. What is the chances that it can go up? Suppose for every 100 trades that you hold beyond the stop loss, what is the chances of that counter going up and recovering? If you say that if most of your trade actually does recover after it hit the stop loss, you have data to prove that, then my question to you is, then your stop loss is wrong already. Then why is your stop loss at a level where it can still recover? Your stop loss should be slightly lower. So that is a whole new topic altogether. But you have to realize that for Nimbus Capital, right, the moment a stop loss is hit, most likely it is not able to recover easily. We have statistical data to prove that. This is mainly because our stop loss are placed below crucial level, crucial chart structure, like support level or resistance turn support or consolidation. If these levels are broken, right, it means that the broad market is no longer interested in this particular counter. Hence, you do not want to be holding that counter anymore, which is why if you continue to hold, you are going to be facing a very, very bad time. But if those structures are not broken, for the case of the other 70% of the uptrend counters like Nvidia, like Marvell, like Micron, like Apple, right? Then these are evidence that these counters are resilient during market retracement. And if they are resilient during market retracement, the moment the market recover, you are going to recover together with the market as well. And what you have avoided is you have avoided taking unnecessary losses. Okay, so that is the main gist of being a profitable trader. You need to limit your loss during the market retracement, because let's say for example, I'm going to use Nvidia as a example again, because this is one of the very good example that I can find. The trade setup for Nvidia was somewhere here. You can see right here. And then it actually retraced. It went up, retraced a bit before it continues to go higher. So when Nvidia retraced during this period here, it was the broad market retrace. If you realize, it was the broad market retrace during this period. You can see that from September to October, the S&P went down, and during this period, a lot of people were running scared, like don't know what's going on. But for us, we don't need to be scared because we have already a plan in place, and just by following that plan, we can profit because our stop loss for Nvidia is somewhere at 165 below a very crucial support level. 165 is somewhere here. It is below this two crucial level, and as long as this two crucial level is not broken, even when the broad market retrace, right, then it goes to show that the market is supporting this counter. The market is willing to buy this counter even when the market, the entire broad market is retracing. And that is how, when overall the broad market become bullish again, this counter will suddenly show up. And that is the true for every other uptrend counter as well. So personally, during currently this market drop, right, you need to ask yourself a few questions. How much has your portfolio been reduced? So personally for me, you can see my portfolio is somewhere around 38.5. So if I round, it's about 39%. So previously, during the height of the recent recovery, when S&P was at its 4,700 here, my portfolio was around 46%. Okay, my portfolio went up to 46%. And then when the market retraced now, it has dropped back down to 39%. In fact, it shouldn't drop so much because I made that big mistake on doubling down on my PayPal trade. But regardless, I was still able to get out of PayPal within my planned risk. But even then, right? Even then, I believe that PayPal trade was a mistake in the first place. But even accounting for my mistake, my portfolio is only down by 8% from its high. And that's not a big number when it comes to trading, because 46 dropped down to 38, right? It's something that I can recover from. So if let's say currently your portfolio is down like 20%, 30%, then there is a issue with your risk management. It is the risk management that is your issue. It has nothing to do with the trade setup. It has nothing to do with the strategy, but rather your risk management. And if you can solve that risk management, right, this kind of market retracement is like almost not a very big issue. You can see that my personal portfolio, I do have some going into quite a negative already. I have LSCC, and also of course the Airbnb, which have from positive have gone down to negative. But these are the kind of loss that I can manage because I already know how much I am willing to lose from the beginning. And for all your trades, right, you should be approaching all your trades with that attitude. And also, as mentioned in my previous past webinar, you should always ask yourself, what if my entire account is hit with a stop loss? How much am I going to lose? And if you are going to lose more than like 30% of your portfolio, then it is a sign that once again you are over trading, you have too many positions, or you simply have too much position in one particular counter. So that is something that you need to work on your end to deal with your risk management. Because for example, right, I have a Nvidia trade right here, the top here. This was my latest entry for my Nvidia trade. And let's say my stop, so I placed my stop loss at 260. Okay, so the reason why it is at 260 is very very simple. Number one, it is below the consolidation level, and number two, it is below this very big green candle with the big volume that you see. These are the crucial levels. Okay, and not only that, I also decide to give a little bit of room, because in case the momentum come down very fast, right, it does have some breathing room, and it does not hit my stop loss straight. So because I know that my stop loss is at 260, and I am willing to lose 2,000 here. Okay, then I can actually use these two parameters to calculate how much shares should I buy right there. And I simply buy that share so that I can adhere to my stop loss. So this stop loss level is very important. And most likely, this stop loss, I will be able to survive this current retracement as well, because let's say market come down, go left, right, and then after that continue to go up, right? If the market remains strong, if Nvidia remains strong, then this stop loss will not be broken. If this stop loss is broken, then I have no reason to be in Nvidia already, because now it has become bearish. Okay, so the key thing is I am able to survive the market because my stop loss is there, not because I am willing to risk 2,000. Let me give you an alternative. What if you decide to enter Nvidia here, same as me, you enter there, but you decide to be very aggressive, very greedy. You put your stop loss here. You put your stop loss here. And you decide to risk the same 2,000. You decide to risk the same 2,000. But now what happened is, now the difference is, I have a 100K account, but you have 10K account. Meaning this 2,000 is actually 20% of your account already. And not only that, your stop loss is like so aggressive that it cannot survive any form of market retracement. Just retrace a bit, right? You are going to be out of the trade already. And not only you are out of the trade, you are going to lose 20% of your entire portfolio. And this is extremely aggressive already, and you should avoid this kind of trade. These are the kind of trade that kills trader, because yes, when the market is bullish, you are going to make a lot of money, but the moment market turn bearish, right, you will lose more money than what you could have gotten during the bullish moment, because number one, you risk so much beyond what you can handle. Number two, your stop loss is also too aggressive that you cannot handle any form of market retracement. In fact, for this one, right, not even saying market retracement, probably the usual noise movement, the usual noise movement of the stock during a bullish period, it will cut you out already lah. So for example, let's say if you enter the video here, and then you put your stop loss here, right? It's very tight, and then you go and risk 2,000 there because you feel that it can chong up some more, but just some random noise movement, you are out of the trade and you are out of $2,000 already lah. So you can see two important aspects playing here. Number one, the placement of your stop loss, and number two, how much are you risking? And if you cannot solve these two, then no matter what course you go, no matter what strategy you use, you will not be profitable. You need to be able to solve these two. And in fact, a lot of courses out there only provide you with the entry. They don't provide you with the stop loss. So a lot of new traders, they think that good entry means everything good already. They take aggressive stop loss. And what happened is, most of the time, even though their entry is good, they enter the market at the right time, they are always wiped out of the market, mainly because they don't know how many shares to buy, they don't know where to place their stop loss. Hence, in my course and in all my trade setup, I done the hard work for you. I have provided the stop loss for you, and the stop loss are not like randomly put there anyhow. The stop loss are back tested and forward tested. How do I know I should place the stop loss there? Because I have 1,000 trade data, or even more than 1,000 trade data, that tells me market can survive a 15% retrace, or market can survive a 12% retrace. I have that number, I have that magic number. And if I place my stop loss slightly below that magic number, no matter how much market retrace, I am still going to be in that trade. And all I need to do is actually just to hold the counter. So that stop loss is given to you in the trade setup already. So on your end, right, you only need to not be greedy and follow proper risk management. And in fact, I have provided the correct risk management level that you should be taking, which is maximum 3% of your portfolio per trade. You should not lose more than 3% of your entire portfolio per trade. So given all these numbers, right, it is a good safety of margin, and if you follow them accordingly, right, most of the time you will see the kind of thing that I personally am experiencing. Whenever market retraces a lot, right, my portfolio dropped by like 5-6%, or maybe like 3-4. If it's a minor retrace, then I will lose like 3-4%. In fact, I will call this a minor retrace. If once again, if it weren't for the PayPal, right, I will still be above 40%, meaning my portfolio dropped like 3-4% like that lah. And these are the kind of drop that is manageable, is extremely manageable. And when it comes to trading, you should not expect to see big spike of profits, Because if every time you see big profit spike coming in, right, whenever market retrace, you are going to be faced with big losses that is coming in also, because you are simply taking too much risk lah. So most of the time your portfolio should be like steadily going up, like 1%, 2%, 1%, 2%, and then once in a while you lose 1%, 2%, and after that it goes a bit. Then something like that, So that is how your portfolio should look like. It should not be looking like this, and then the next trade is like that, and then the next trade is like this, and then the next trade is like that, and then the next trade like this, and then after that like that. But at the end of the day, you are still in a loss. But whereas small and steady position like this is not only more, I would say, effective, it is also easier for you. It's easier on the mind. You can sleep at night knowing that even if the S&P drop 10%, your portfolio is fine. So you do not need to be like up 3-4 a.m. in the morning looking at Alibaba and pray that please lah, don't drop already lah, come on, drop enough already. You won't be end up in that situation. Personally, for me, even when PayPal dropped so much, yes, it was a little bit of pain for me, but I mean, is already expected. I mean, not expected, but I have already planned for it, and I just take the loss and move on. So small losses are easier to move on. Big losses, people cannot move on. And in fact, traders who have big losses are the ones that tend to hold on to their losses because they simply cannot accept that loss, and they hold on to it, and then that loss compounds some more and more. Okay, so that's basically what I want to say. So taking a bit at Singapore market, we do see kind of divergence, I would say, in that while the US dropped quite significant last night, the Hong Kong seems to be doing relatively okay. We did not see that same level of drop on the same day lah. And in fact, Singapore, I'm not sure what's going to happen today, but we do see DBS recovers 5%. DBS recover yesterday 5%. Now market open already lah. Market open now, it is like gap down some more, but we do see the Asian market kind of like getting supported, but it's still too early to tell. It's still too, because hopefully DBS can hold the weight of the Singapore market lah. So I'm not sure how much. Yeah, we can see that Singapore market kind of finding a bit of support, but once again, right, it is still a bit early to tell. We should not suddenly jump in, but we see if this support can sustain or not, and whether or not if yesterday market drop was an overreaction, or is it truly another big downtrend that is coming. Although I don't believe it is lah. Every time there's a big downtrend that comes, there's always a trigger, there's always a catalyst, and usually if we know what the market is dropping, right, most likely that catalyst is not significant enough lah, because we already have that COVID catalyst back in 2020 already, and that same, no matter whatever the variant is, right, I don't think it will impact so much. So that comes to the end of my market update. So the important things are, once again, right, do not panic. Do not suddenly exit all your position and then start shorting counter, or start bottom picking, or all those that have fallen so far. Respect your stop loss, and most importantly, please respect your risk management. Do not risk more than 3%. This is the thing that no one can control. Like, if you don't do it, no one can point a gun at you to do it, but it is something that you should be doing, because there is no strategy in the world. There's no guru, there's no fund manager, there's no one in the world that can provide you with a 100% accurate strategy that you can forego your risk. Every strategy needs to come in with a risk, and in fact, the risk is inbuilt into the strategy itself. So if you decide to not follow the risk, right, then you are not following the strategy already. Whatever you are trying to do is your own strategy already. It's not what that has been taught to you or what that has been shared with you. Okay, so make sure follow your risk and your stop loss. So hopefully in the coming days or maybe in the next week, we can see some kind of a recovery in the market going towards Christmas. And since we have reached December, right, it is going to be a very fast month, since the last week of December usually not active. So we might see some market movement coming in the first 3 weeks of December lah. So just stay strong and stay disciplined. Have a good day, my friends, and take care.